Hi again. Let's get started with Part 2A of Chapter 5, where we start a comprehensive example of our four costing methods. As we discussed toward the end of Part 1, when identical units of inventory are purchased at different costs, a question arises about which methods we should record in cost of goods sold and which amounts remain in inventory. Now, four methods are commonly used to assign cost to inventory and a cost of goods sold. The first of these is specific identification. It's the easiest to understand because we track the exact cost of what we sell because we have identified it to our purchase invoice. Companies who use specific identification include car dealerships and other businesses that sell individually unique products. Think about Tiffany's. Now, for other methods, we make assumptions about the inventory cost flows. First in, first out, or FIFO, assumes cost flow in the order incurred. In other words, the first inventory items purchased are the first inventory items sold and reported in cost of goods sold. This also means that the items purchased most recently are assumed to be an ending inventory. When you think about FIFO, think about how a grocer would want milk to be sold first into the store, first out of the store. The word out means sold. Now, the opposite is true for last in, first out, LIFO. It assumes cost flow in the reverse order incurred. The last inventory items purchased are the first inventory items to be sold and reported in cost of goods sold. Therefore, the earliest inventory purchased is assumed to still be in ending inventory. Now, when you think about LIFO, think about how a lumber yard might sell lumber off a pile. The last lumber onto the pile would be the first lumber a customer would be inclined to buy. Again, out means sold. Finally, weighted average cost averages the cost of beginning inventory and purchases together to come up with an average cost for items sold and in the residual ending inventory. And a final important note. The flow of costs in the accounting records is determined by the method selected. They do not need to flow the same way that the physical inventory products do. The cost flow assumption selected by a company can have a huge impact on gross profit and on inventory balances. And we'll see more about this later in this chapter. We will illustrate the inventory cost flows using data from Laker Company. This would be a good time to pause the video and open your textbooks to exercise 5.3. Also, print the Chapter 5 Costing Methods template and specific identification template that I put out there for you in D2L. I've also provided you with a blank template that you can use to solve your homework or to use for the exam. Now, Laker sells one product, and its January purchases and sales data are shown on this slide and in the textbook. It starts January with 140 units in inventory, purchases 240 units, sells 180 units, and ends the month with a difference. Okay, 200 units. Beginning inventory was valued in the books at $840, and purchases cost $2,700. So total cost of goods available for sale was $1,950. The challenge for us will be to determine how much of the $1,950 should be allocated to the 200 units still in ending inventory, and how much cost should follow the 180 units into the cost of goods sold account. A word of caution for you then. Notice in the middle section of the screen there's a section about the units sold. It's the same in the textbook. The dollars sold are the sales dollars at the retail sales price. This is not the same as the cost of the units. It is what will be recorded as sales revenue and accounts receivable when the units are sold. And then the second part, of course, is to record the sales transaction for cost of goods sold. And we still don't know what the amount will be. We will begin our costing discussion then looking at specific identification, then move into FIFO and LIFO and weighted average cost methods. So please use the specific identification template from D2L to work through the solution for that method. It's fairly straightforward. Then use the costing methods template to fill in the solutions for FIFO, LIFO, and weighted average cost. And as part of our discussion, we will also determine the impact on net income of each of the costing methods, then compare the results of the 4 methods overall. As business people, the analysis of the impact on net income should be interesting to you. Okay. Our objectives then for each method will be as follows. First, determine how much cost is assigned to ending inventory and the cost of goods sold under each costing method. And then secondly, to prepare an income statement showing the computation of gross profit and net income. We're going to assume the tax rate is 40% and operating expenses are $1,250 for any method. Now, notice as we go along that there are 3 key variables in determining a dollar value of ending inventory: the inventory quantity, costs of inventory, and third, the company's cost flow assumption. Please pay attention to dates as they have a major impact on your results. So let's talk first about the specific identification method. The specific identification method is the easiest of the methods to understand, as I've mentioned. This method is not really a cost flow method because it individually identifies and records the cost of each item sold as part of cost of goods sold. This method requires accountants to keep track of the purchase cost of each item. Because it's so time-consuming, the specific identification method is used primarily to account for individually expensive and unique items. Did I say Tiffany's? Companies who use specific identification include Toll Brothers, the country's leading builder of luxury homes. It also includes CarMax, a national auto dealership, and Boeing, a leading manufacturer of military and civilian aircraft. As I noted previously, specific identification is the easiest of the methods to understand conceptually because when we sell an inventory item, we sell it at its original invoice cost. In a nutshell, you use the facts given about the ending inventory and the units sold, okay, to determine the cost of goods sold and the cost remaining in ending inventory. As you recall, cost of goods sold is subtracted from sales to determine gross profit and ultimately leads to net income. I'll not be demonstrating this method any further in our video, but you'll find a nice example in your textbook and a handout in D2L that mirrors the video, and you will also do it in your homework. If you have trouble understanding the process, please post a question on the chapter discussion board. And as a side note, even though specific identification is the easiest to understand conceptually, it's the hardest to do in practice because companies must keep incredibly detailed records of every inventory item purchased and sold. Does that make sense? The first in, first out, or FIFO method of assigning cost to both inventory and cost of goods sold then assumes that inventory items are sold in the same order they were purchased. When sales occur, the cost of the earliest units acquired are charged off to cost of goods sold, and this leaves the cost of the most recent purchases in ending inventory. When inventory costs are rising, higher costs will remain in inventory and lower costs will move to cost of goods sold. This is important to understand. Net income will be higher than under LIFO and under weighted average. And the opposite is true when inventory costs are steadily falling, as we'll see in our example. To best remember FIFO, think about how a grocery store wants to sell its milk and meat, wants to sell the earliest purchases first. At this point, please pull out the Chapter 5 Costing Methods template to take notes. My suggestion is that you try to work ahead of me. Pause the video, fill out the template, then turn the video back on to find out whether you got the right answers. This exhibit starts with beginning inventory of 140 units costing $6 each. On January 10th, 100 units were sold, and since the only inventory available to sell from cost $6 each per unit, the $100 worth of bikes sold had a cost of $600. This leaves 40 units costing $6 each for a total cost of $240. Please be careful when recording the cost of sale. Don't get confused by the retail price of $15 given in the facts. The retail price is the amount charged to the customer. It is not a factor in the calculation of inventory cost. The only time retail price is important is when recording the sales journal entry. Speaking of journal entries, do you remember the 2 journal entries we make to record the sale of inventory? I've included them here for you as a reminder. One for sales at the retail price of $1,500 in total, and one for cost of goods sold of $600. So please don't forget the entries you've learned in Chapter 4 because you will see them on the exam. Hint, hint. On January 20th, 60 more units costing $5 each are bought for a total of $300. Inventory now consists of 40 units at $6 each and 60 units at $5 each for a total of $540. Just for fun, can you journal the entry required to record the purchase? I thought so. Here it is. You should be very comfortable with this journal entry by now. On January 25th, then, 80 units are sold. Now, this is where it gets tricky. Which of the 100 units available should we sell? Those costing $6 or those costing $5? Well, we have to sell some of both, but which ones? Remember, using FIFO, you sell the units in the order you bought them. This means the first 40 units sold were acquired on January 10th for a cost of $240. The remaining 40 units sold were acquired on January 20th at a cost of $5 apiece or $200. And the total cost of sales on January 25th was $440. The sale leaves only $20, 20 units in inventory, all from the January 20th, with a total cost of $100. And finally, on January 30th, 180 more units were purchased for a cost of $450 apiece, or $810 in total. Now, this purchase is added on to the inventory previously on hand on January 25th. Now we have 20 units costing $100 and 180 units costing $810 for total quantity in the warehouse of 200 units costing a total of $910. Notice that Laker's FIFO cost of goods sold is reported on its income statement, reflecting the 180 units sold, and 1,040, which is 600 plus 440, and its inventory, ending inventory, reported on the balance sheet, reflecting 200 units unsold as $910. Let's look at the income statement on the next slide. After cost of goods sold is is subtracted or deducted from sales, liquor company has gross profit of $1,660. Subtracting operating expenses of $1,250 and income taxes computed at 40% of 164 leaves the company with net income of 246. We'll see this is actually lower than LIFO net income because inventory costs are declining. Please pause to review the facts given in this exercise at this time if you need to do so. So it's time for a quick break, but before you go, see if you can answer these 5 questions. The cost of inventory includes only the invoice price paid and never any shipping or storage costs. Inventory cost flow assumptions allocate the cost of goods available for sale between accounts receivable and accounts payable. Specific identification is a costing method used for individually unique and expensive items. 3 other acceptable inventory costing methods are first in, first out, FIFO, last in, first out, LIFO, and first in, still here, or FISH. In a period of rising inventory costs, FIFO yields higher inventory cost, lower cost of goods sold, and higher net income than does LIFO. The opposite is true in a period of declining inventory cost. Make an educated guess here. At this point in the presentation, I always feel like my dog Theodore. I want some cookies. Anyone else feel the same way? See you in a few minutes.